March 2025. Beijing. A BlackRock fund just walked away from a Chinese office complex. Just walked away, stopped paying the loan, forfeited the property to the banks, left it behind like a bad Tinder date. The property, about to be sold at a 40% loss. Now, when you or I walk away from a bad investment, it's called poor life choices. When BlackRock, the single largest asset manager on planet Earth, with $13.5 trillion under management, walks away from an investment, it's called a signal. A very, very loud signal. This is the firm that manages money for everyone from your state pension fund to sovereign wealth funds. They don't sneeze without running 17 quantitative models and consulting 3 Nobel Prize winners. And they just walked away from a Chinese property. But here's the thing that should make your spine tingle. That property forfeit, it's not an isolated incident. It's part of a pattern. A pattern of the world's smartest money very quietly heading for the exits in China. And if BlackRock is leaving, maybe just maybe they know something you don't. Before we dive into what's happening in China, you need to understand exactly who BlackRock is, because this isn't just another investment firm. This is the investment firm. BlackRock reported $13.46 trillion in assets under management as of September 2025. Let me put that in perspective for you. That's more than the GDP of every country on Earth except the United States and China. This single company manages more money than exists in the entire economy of Japan, or Germany, or India. When you hear about passive investing, index funds, ETFs, BlackRock is the puppet master pulling those strings. They're one of the big four fund managers alongside Vanguard, State Street, and Fidelity. Combined, these firms manage over $15 trillion, 3/4 of U.S. gross domestic product. Here's something that'll keep you up at night. A 2019 study found that either Vanguard, BlackRock, or State Street is the largest listed owner of 88% of S&P 500 companies. 88%. They don't just own a piece of the market. They basically are the market. The man at the helm, Larry Fink, CEO since BlackRock's founding in 1988. A man so influential that when he writes his annual letter to CEOs, entire boardrooms scramble to comply. When he talks about ESG or stakeholder capitalism, trillion-dollar industries pivot. And then, there's Aladdin, BlackRock's risk management software that tracks investment portfolios for most major financial institutions worldwide. Think of it as the Matrix, except instead of controlling humans, it's tracking virtually every significant investment decision on the planet. From $2.7 billion in assets in 1989 to $13.5 trillion in 2025. That's a 19% compound annual growth rate sustained over 36 years. They've survived every crash, every crisis, every this time is different moment. These are not amateurs. These are not dumb money. When BlackRock moves, it's for a reason. So when they start quietly backing away from the world's second largest economy, pay attention. Now, BlackRock's relationship with China is complicated. And by complicated, I mean it's the financial equivalent of a relationship that looked great on Instagram, but was a complete disaster in real life. In 2021, BlackRock became the first foreign-owned company allowed by Beijing to operate a wholly owned business in China's mutual fund industry. It was a huge deal. Massive. The kind of market access foreign firms had been salivating over for decades, and BlackRock got there first. In September 2021, BlackRock launched its first mutual fund in China and raised 6.68 billion yuan, $1.03 billion from 111,000 Chinese investors. They closed the subscription period in days instead of the planned 2 weeks because demand was so intense. Larry Fink was practically doing cartwheels. This was validation. This was the China dream. 1.4 billion consumers, a growing middle class, an economy that supposedly couldn't stop growing. And then George Soros, George Soros published a Wall Street Journal op-ed calling BlackRock's China expansion a tragic mistake that would damage the national security interest of the U.S. The investment world split into two camps. One side, Larry Fink, Ray Dalio, Steven Schwartzman, billionaires who saw China as an unmissable opportunity. The other side, Soros, Paul Marshall, and a growing chorus of skeptics screaming that China was uninvestable. Fast forward to 2025. Who was right? BlackRock's China Flexible Equity Fund, down 30.5% in 1 year, down 25% from its initial level in 2017. The fund attracted only $21.4 million in assets, pocket change for a firm managing trillions. In September 2023, BlackRock announced they were shutting it down. Reason cited: lack of new investor interest. Translation: nobody wanted to touch it with a 10-foot pole. But it wasn't just one fund. Oh no, that would be too simple. This is where the story goes from interesting to Houston. We have a problem. June 2025. BlackRock's head of China offshore wealth Steve Zhu departs after almost 8 years. Just leaves. In the middle of what should have been a booming wealth management market. March 2025. That office complex I mentioned, the one BlackRock just walked away from, Standard Chartered and other lenders had to take over. The property is being sold at more than a 40% discount. BlackRock and the banks are eating massive losses. Think about that. BlackRock, the firm with the most sophisticated risk management on the planet, miscalculated so badly that walking away and eating a total loss was the better option than staying in. 2021. BlackRock closed down its entire private fund business in China after just 3 years. They liquidated all 3 private fund products ahead of schedule. September 2024. Hamish McDonald, BlackRock's head of Asia-Pacific real estate, goes on record: "It feels like we are a long way away from actually investing in that market. China is not part of our investment strategy at the moment because we are not convinced of a deep liquid exit right now." Read that again. Not convinced of a deep liquid exit. In plain English, we don't think we can get our money out. And then there's the political heat. July 2023. BlackRock CEO Larry Fink gets hauled before the U.S. House Select Committee on Strategic Competition with China. They're investigating whether BlackRock funneled American investments into blacklisted Chinese firms. February 2025. 17 U.S. state attorneys general, from Montana to Alabama to Idaho, send BlackRock a blistering letter, accusing them of making material misstatements and omissions about the risks of Chinese investments. They specifically call out BlackRock for downplaying the threat to Taiwan, misrepresenting forced labor in Xinjiang, and basically sugarcoating the fact that China is a designated U.S. foreign adversary. So we have fund closures, executive departures, property forfeitures, congressional investigations, and public rebukes from state officials. This isn't a strategic repositioning. This is a retreat, and BlackRock is just the canary in the coal mine. Here's what the mainstream financial media isn't telling you. BlackRock isn't alone. Not even close. The great foreign investor exodus from China is happening right now, and it's accelerating faster than anyone wants to admit. China's inward foreign direct investment peaked at a record high of $344.1 billion in 2021. By 2024, it had plummeted to $4.5 billion, the lowest level since 1991. Let me repeat that. The lowest level since 1991, before most of you were born, before the internet, before China was even part of the WTO. In the second quarter of 2024, overseas firms pulled a record $15 billion out of China. Not into, out, and it's not just BlackRock. A January 2024 Bloomberg analysis looked at 271 U.S. pension funds with assets larger than $500 million. Want to guess how many held Chinese shares listed on Wall Street? 14. Out of 271. That's 5%. The people managing your retirement money want nothing to do with Chinese stocks. 90% of foreign investors who were bullish on China a year ago have headed for the exits. Many of them are also nursing wounds from property company defaults on high-yielding, dollar-denominated bonds. The hit to share prices in Shanghai, Shenzhen, Hong Kong, and New York has reached $7 trillion since early 2021. $7 trillion. That's not a correction. That's a wipeout. That's generational wealth evaporating like morning dew. Want to know why BlackRock forfeited that property? Let me paint you a picture of China's real estate market, a market that was supposed to be too big to fail. Real estate accounts for roughly 25 to 30% of China's GDP. That's not a typo. Almost a third of the entire economy is tied to property. The China Housing Price Index has steadily declined since its mid-2019 peak. No meaningful recovery, just a slow, grinding descent into the abyss. Remember Evergrande, Country Garden? These weren't small-time developers. These were titans, and they defaulted on hundreds of billions in debt. The real estate debacle saddled China's local governments with $13 trillion in debts. 13 trillion with a T. Over January-November 2025, real estate development investment fell 15.9%. New construction starts declined more than 20%. Developer funding dropped nearly 12%. And here's the kicker. While unsold inventory edged down slightly toward year-end, there were no clear signs of a cyclical bottom. Translation: it's still falling, still getting worse. The bottom? Nobody knows where it is. Foreign invested fixed asset investment fell 14.1% over the same period. Foreign money isn't just leaving, it's fleeing. You know what all of this reminds me of? Japan. And if you know your economic history, that should terrify you. In the 1980s, Japan was unstoppable. The next economic superpower, Tokyo real estate, was supposedly so valuable that the grounds of the Imperial Palace were worth more than all of California. And then the bubble burst in 1991. Housing starts peaked and then collapsed. Stock prices cratered. And Japan entered what economists now call the lost decades, plural of economic stagnation. The parallels are eerie. Housing bubble, check. Overleveraged companies, check. Demographic crisis, oh, we'll get to that. China's housing slump looks almost identical to Japan's pre-collapse trajectory. The question isn't if China will have a Japan-style crisis. The question is, will it be worse? China briefly dipped into deflation twice in the past year and sits at around minus 0.7% inflation. Consumer prices fell year on year in several months of 2025. Deflation, the killer of economies. The thing central banks fear more than almost anything else, because once it starts, it's almost impossible to stop. Personal consumption expenditures and consumer confidence have plunged since 2021. Consumption accounts for just 39% of GDP in China versus about 75% in the US. For China's household consumption to match the US share of GDP, the average Chinese family would have to consume 70% more. That's not happening, not even close. So we've got a real estate crisis. But that's just problem number one. There are two others that make the property mess look almost manageable. Crisis number two, the demographic time bomb. In 2023, deaths outnumbered births in China for the first time. Over 300 million Chinese are older than 60 and nearing retirement. 40 years of the one-child policy created this disaster, and there's no fixing it. You can't just start making babies and solve a demographic crisis. This is a multi-generational problem. China's working-age population is shrinking fast, which means fewer workers, less consumption, and a growing pension crisis that nobody knows how to fund. Crisis number three. The growth model has hit the wall for decades. China's formula was simple: suppress household consumption, undervalue the currency, and export like crazy. Chinese households subsidized the country's rise through foregone returns, while the rest of the world gorged on cheap Chinese goods. But that model is done. Foreign exchange reserves have barely grown since 2017. The social costs of financial repression are mounting. Over January-November 2025, fixed asset investment fell to 0.6% year-on-year, with private investment down 5.3%. Private investment, the engine of real economic growth, is collapsing because private businesses have figured out what BlackRock is learning. The game has changed, and not in China's favor. Add in escalating trade wars, technology restrictions, rare earth export bans, and geopolitical tensions, and you've got a toxic cocktail of economic headwinds: real estate crash, demographic collapse, growth model breakdown. Any one of these would be manageable, all three at once. That's an economic perfect storm, and BlackRock sees it. They've run the models, they've crunched the numbers, and they're heading for the door. So how do you know when the smart money is leaving? Because they're not going to send you an email saying, "Hey, we're bailing on China. Thought you should know." No, you have to read the signals, the breadcrumbs they leave behind. Signal number one. The language changes. Remember Hamish McDonald's quote, "China's not part of our investment strategy at the moment." In corporate speak, that's DEFCON 1. That's "we're out, and we're not coming back anytime soon." When asset managers start using phrases like "not convinced of a deep liquid exit," they're telling you they think the money trap has already sprung. Signal number two. The talent leaves. June 2025. China offshore wealth head exits. You don't lose key personnel in a market you're bullish on. You lose key personnel when the ship is sinking and the captain is looking for the lifeboats. Signal number three. Fund liquidations. BlackRock has shuttered multiple China funds, not restructured, not rebranded, liquidated. Game over. Thanks for playing. Signal number four. Walking away from assets. That March 2025 property forfeit. That's BlackRock saying the pain of holding this exceeds the pain of the loss. Think about what that means. They did the math, they ran the projections, and eating a 40% plus loss today was better than holding for tomorrow. That should scare you. Signal number 5. Political heat. They don't fight when 17 state attorneys general accuse you of misleading investors about China risks. You could fight it. BlackRock didn't. They acknowledged the criticism and moved on. Why? Because fighting it means defending your China exposure. And defending your China exposure means, well, defending your China exposure. They'd rather take the PR hit than double down on China. So what does BlackRock know that ordinary investors don't? What do their models show that makes billion-dollar losses acceptable? Remember Aladdin, BlackRock's risk management platform? It's tracking data points most of us can't even conceive of. Capital flows, correlation risks, liquidity stress tests, political risk factors. They're not guessing. They're modeling hundreds of scenarios simultaneously. And those models are screaming one thing: get out while you still can. Here's something most investors don't think about. China has strict capital controls. You can't just sell your assets and wire the money to New York. There are limits, restrictions, bureaucratic hoops. Chinese nationals are only allowed to transfer the equivalent of $50,000 out of the country each year. Foreigners have more flexibility, but there are still constraints. BlackRock knows that if everyone tries to exit at once, the exits get sealed. It's like a crowded theater when someone yells fire. The first people through the doors are fine. The last ones, not so much. And they know something else. When institutional investors move, they move as a herd. Once the exodus becomes obvious, it becomes unstoppable. So they're moving now quietly, before the panic, before the capital controls tighten, before the political situation deteriorates further. They've calculated that the potential returns in China no longer justify the risks, not even close. And for a firm that lives and dies by risk-adjusted returns, that's game over. And it's not just foreign investors. The Chinese themselves are trying to get out. China's millionaires are seeking exit visas in record numbers. Destination: Singapore, Canada, the United States. Henley and Partners, the citizenship advisory firm, reports a surge in Chinese high net worth individuals seeking second passports and foreign residency. Wealthy Chinese are turning to underground money handlers to circumvent capital controls. It's a vast global network facilitating transfer of funds through channels that would make money launderers blush. Others are buying gold bars and cryptocurrency to move wealth, because while you can't wire $10 million to Singapore, you can buy gold, fly with it, and sell it there. Chinese buyers have accounted for the largest cohort of foreign buyers of luxury homes in Singapore. They've set up hundreds of wealth management offices there in recent years. It got so intense that Singaporean authorities started rejecting Chinese family office applications over money laundering concerns. Think about what that means. The people who made money in China's rise are trying desperately to get their wealth out of China. If the winners are leaving, what does that tell you about what's coming? And then there's the thing nobody wants to talk about but everyone's thinking about: Taiwan. China has made clear its intention to reunify with Taiwan. The question isn't if they'll try, but when. Taiwan is home to TSMC, Taiwan Semiconductor Manufacturing Company, which produces the majority of the world's advanced chips. This is the company that makes the chips in your phone, your car, your laptop. If China moves on Taiwan, global supply chains don't just hiccup, they implode. The economic shock would make COVID look like a mild inconvenience. The 17 state attorneys general specifically called out BlackRock for not adequately disclosing the Taiwan invasion risk in fund prospectuses. BlackRock's response: they added language about China's threats of invasion and how military conflict could adversely affect securities of Chinese issuers. Translation: we know it's a risk, a big one, and we're finally admitting it in the fine print. The US-China rivalry isn't going away. If anything, it's intensifying. Technology restrictions, trade wars, military posturing, rare earth export, bans, sanctions, counter-sanctions. The world is splitting into two financial ecosystems: dollar-based Western system, yuan-based Eastern system, and companies like BlackRock are being forced to choose sides. For decades, BlackRock could play both sides, make money in China, make money in the US, everyone wins. Those days are over, and BlackRock is choosing the side with $13 trillion in assets already under management in stable, developed markets over the increasingly treacherous terrain of China. So here we are. The world's largest asset manager is quietly executing an exit strategy from the world's second largest economy. And they're not doing it because they hate money. They're doing it because they've run the numbers. Okay, you're thinking, so BlackRock is pulling out of China. Why should I care? Because there's a decent chance your retirement money is tied up in this mess. If you own a global index fund, an emerging market fund, or pretty much any diversified investment vehicle, you have China exposure. Maybe not direct, but it's there. And when China stumbles not if, WHE, and those effects ripple through global markets, supply chains, commodity prices, currency valuations, everything connects. Remember 2008, when the US housing market crashed and took down the global financial system? China's real estate market is 3 times the size of America's was back then. If China's property sector fully implodes, nowhere is safe. So what do? Check your portfolio. Know your China exposure. If it's high, maybe reconsider. Watch institutional money. Follow what BlackRock, Bridgewater, Vanguard do, not what they say, what they do. Diversify. If there's one lesson from every financial crisis, it's that concentration kills. Don't panic, but don't ignore the signals either. The exits are still open, liquidity still exists, but the crowd is gathering at the doors. This story isn't really about BlackRock or China, not really. This is about the end of an era. For 40 years, the story of global economics has been China's rise, the sleeping giant awakening, the inevitable superpower. But every rise has a peak, every boom has a bust. Every this time is different, ends the same way. It wasn't different. Foreign direct investment in China, from $344 billion to $4.5 billion in 3 years. That's a 99% collapse. You don't recover from that without fundamental changes, and China shows no signs of making those changes. Instead, they're doubling down on state control, party dominance, self-reliance, all the things that drive away foreign capital. BlackRock won't be the last to leave. They're just the first big name to make it obvious. Watch for others to follow. Fidelity, Vanguard, JPMorgan. The pension funds, the sovereign wealth funds. The exodus has begun. It's quiet now, orderly, professional, but it's real. Give it 2 years, maybe 3, and what's a trickle now will be a flood. By then, the narrative will shift. The media will discover that China's economy is in crisis. Analysts will write shocked reports about the foreign investor exodus, and BlackRock will be sitting back in New York, portfolio already repositioned, thinking, yeah, we saw that coming. Because that's what happens when you're the smartest money in the room. You don't wait for the crisis. You don't wait for the headlines. You don't wait for permission to protect your capital. You read the signals. You trust your models. And you move. That office complex in Beijing, the one BlackRock walked away from, it's not just a real estate loss. It's a message. And smart money is listening. If this video just changed how you think about your investments, hit that subscribe button. Because if you think this story is over, you haven't been paying attention to what comes next. Until then, watch what the smart money does. Not what they say, what they do. Because when BlackRock forfeits a property and eats a 40% loss, that's not a mistake. That's a strategy. And the strategy is, get out while you still can. See you in the next one.